everybody. Welcome to this Friday workshop. Glad you could be with us. My name is Ashley Jones, the Managing Director of Community Programs here at the Venture Center. And like I said, we're so excited that you could join us today to learn about this 2020 Tax Prep Toolkit. That's a lot of T's, tongue twister. We're so excited to have Jason Thomas with us from Frost PLLC, as well as Lindsey Jackson with Frost PLLC. And again, today's topic is going to be discussing the ins and outs of the CARES Act legislation and its tax implication for taxes, employees and employers, and of course, the Payroll Protection Program, or PPP, that we're all pretty familiar with at this point. I do want to take a moment to thank all of our sponsors that support all of our community programs and efforts to get the message out to entrepreneurs. Of course, Frost PLLC, Simmons Bank, Wright Lindsey Jennings, and the Little Rock Regional Chamber. Thank you all for your continued support in our mission to drive entrepreneurship and answer questions and inspire and encourage. Also want to let folks know about our upcoming programs. The Venture Center hosts a variety of programs throughout the year. Some that are coming up that I want to put on your radar. On March 17th, we have a fireside chat with George Macris, who's the Simmons Bank CEO. So this is going to be a fun conversation between him and Wayne Miller, our executive director, to learn how George found himself in this role with Simmons and his growth and maneuvering throughout the business community and in that regard. So lots of questions to come from that. Also on March 19th, we've got a Lift the Rock program. We're going to hear from the iFund, which is another local entrepreneur support organization, as well as a local entrepreneur, Staley House and the Free Arm, who some of you may be familiar with. They're going to share their story on March 19th at noon. And also March 24th, we've got an ICBA Think Tech Demo Day. So those that are familiar with our FinTech accelerators, that's coming to a close, at least the ICBA one on March 24th. So be sure to register for all of those events and we'll see you there. Want to go ahead and turn it over to Jason and Lindsey. Go ahead and give an introduction and then I'll let you guys share your screen and jump in.
All right. Yeah, thanks, Ashley. As Ashley said, Jason Thomas with Frost here in Little Rock. Lindsey Jackson is in Raleigh, North Carolina. Lindsey is a senior tax manager in our practice and has a deep technical knowledge of a lot of these topics we have today. So we're thrilled to have her here with us. And Lindsey, if you want to say hi.
Hi, everyone.
So, and then thank you again for the Venture Center for letting us host this webinar. And while we're in the knee deep into tax season already, we hope there's some information that comes out of this today that's helpful for everybody. So I will start sharing my screen, and what we'll do is we'll go through these slides today and work through this information and then open it up for Q&A. All right. Everybody see my slides? If you have any problems, just yell. Pandemic topics, I think, will take up a lot of what we're going to talk about today. And it's an unfortunate fact that every webinar and presentation I've done in the past year, or since 6 months out of a year ago today, has addressed these topics. But it is continuing to be obviously very relevant in what we're doing in our everyday lives and in particular with our businesses. So there's been obviously some breaking news this week with the new stimulus package put out by the new administration and passed by Congress. President Biden signed that yesterday, so we will briefly touch on that some today. And they're calling the new stimulus bill the American Rescue Plan Act.
I'm sorry, Jason, will you do me a favor and make sure you're in presentation mode?
Okay. Oops, yeah.
Just so it's a little bit bigger for folks to see.
There you go. Okay, is that better?
I think we see.
Now I need to do a different screen.
Yeah.
Hold on.
Make sure you're in slideshow.
Is that better?
Yes, perfect.
Okay, there you go. So where I was, the new stimulus bill is $1.9 trillion legislation. As noted, it was sent to President Biden for his signature on Thursday. He did sign it. Obviously, we're not going to cover all of it today, but a few key provisions. One in particular being that the first $10,200 of unemployment benefits for those individuals or households making less than $150,000 is non-taxable. There has been some talk already that this provision alone may justify an extension of the tax deadline yet again. As a practicing CPA, my desire is to keep things as they are and let me have my summer back. Beyond being in the middle of a pandemic, losing my summer last year to continue to prep taxes, even though we do that on a normal basis, to have a deadline just took a little bit of the wind out of our sails. So let's hope that doesn't stick. It did expand upon three key tax credits: the child tax credit, the earned income tax credit, and the child independent care tax credit. What has been noted particularly is the child tax credit. It raises that $2,000 credit to $3,000 and set the credit at $3,600 for parents of children under ages of 6. And if you have a 17-year-old or under, you're also eligible. This credit is fully refundable, which is a very nice bonus for our taxpayers. Last year or any year, employees and business owners have to pay in at least 90% of their taxes before the due date. To avoid penalties, most people have those taxes withheld. If you don't, then you pay the price, and then there's a lot of people that go ahead and do that. However, in most years, those payments are due in April, June, September, and January, the 15th day of those months. However, as I just mentioned, with the expansion with the change of the tax deadlines came a change of estimated tax payments when they were due. So what we did last year was we bumped the April 15 deadline to July 15. And so penalties didn't start to accrue until July 15, but you absolutely had to make your payment. I had a lot of clients who wanted to go ahead and pay in April, wanted to stay on their same routine and path, but had a lot that did defer until July 15. The IRS has not made any announcement for waiving underpayment penalties for 2020. I wouldn't expect that they will, but do note that there has been a lot of timing issues with the IRS. So if you did send in a payment and for whatever reason it wasn't cash timely, and you've received notices, it is worth examining and reviewing to see if there's any relief for you there. Stimulus payments, it's been a popular topic. Of course, the new stimulus bill included additional stimulus payments. Those stimulus payments are not taxable. If you haven't received a payment, you can still claim it on your 2020 tax returns if you do qualify. These payments are an advance payment of a tax credit for 2020. And that's a little bit more on the technical side. Most people just say, did I get my cash? And it was able to put it in my bank account and do whatever I needed to do with it. But that's really what they were structured as. You can claim your stimulus amount still due on line 30 of your 1040. Normal tax rules do still apply, so you may not receive the full amount if you owe back taxes or child support. Parents of children born in 2020 may also be eligible to claim a rebate credit. Estates of those who died before January 2020 cannot receive payments. Those who died during 2020 are eligible. I didn't run into this. I know there were some people who did. Lindsey, did you happen to have any estate issues? I can't remember if it was you or somebody else I talked to.
Yes, I did have an instance where an estate received a stimulus payment, and the IRS has put out guidance on what to do if that happens to you, and there's an address where you're supposed to mail that payment back.
Okay. Yeah, so that's kind of a little bit of a quirk that people had to work through last year. I'm going to turn this section and a couple of the next ones over to Lindsey. As we all know, I know the people everybody at the Venture Center and was remote for a while. We were as well, but most of us here just went home to wherever we were in Central Arkansas or in Lindsey's case in Raleigh. But we did have a lot of clients. I had several clients whose, especially in the Northeast, where those employees had traveled, were traveling into maybe New York City or elsewhere to work. And when they actually were sent home, they went to different states. So I'm going to turn this part over to Lindsey and let her talk through this issue for you.
Yeah, so as Jason mentioned, people kind of tended to scatter. Some went home to be with their families. Others may have been commuting and stayed in their house. And what people didn't realize is that this could have opened up some tax questions, and it can, from the employee side and the business side, maybe create filing requirements in states that you wouldn't have normally filed in or had to pay taxes. And from a business perspective, you would have employees working in states where you didn't before, and you may need to file a tax return there. And from the employee side, you may not have had your wages withheld or changed to be withheld in the state that you started working in, and could have some filing requirements in a different state. But the good news is a lot of states recognize that this happened and have put out guidance to this issue. So if you fall in one of these categories, it's definitely something to bring up with your tax preparer and CPA to just have these discussions early on in the process so that there aren't any surprises for anyone. And then part of that is when people went home, everyone started, thinking, well, what about my home office? And can I deduct expenses for setting things up? Because most of us probably weren't set up as well as we would have liked to be able to work from home. And it took a bit of an adaptation period. And one thing to note is that home office deductions are really available for business owners. They're not geared so much towards people that are W-2 employees. But if you are a business owner and you have made a dedicated space in your house that has been transformed into an office that you are using and had to put, expenses into making that happen, that's also a deduction that you can claim on your 1040.
And what kind of, Lindsey, have you run into any questions on type of expenses or expenses that may be pushing the envelope in terms of deductibility?
Most people that I've talked to on this topic have been pretty straightforward. It is, kind of geared towards a portion of your utilities and your mortgage or rent payments and things like your office equipment or furniture. I wouldn't go a little too crazy and outside of the box on this particular deduction, but if it's something that you would use in the normal course of business, it's certainly deductible under this.
Right. And I do think the other thing that I would note on home offices is consider the space that you're evaluating. I have not run into this, but I've heard some horror stories about IRS agents coming in wanting to examine a home office, and maybe that office, had multiple uses. Maybe it was a large family playroom, and maybe you did have a desk and a computer in that, and they were really questioning, was this a dedicated space? And even if you're running utilities through as part of your deductions, should you have been allowed 100% of those utilities? So I do think that this was somewhat of a hot button issue for a while with some IRS agents on a smaller scale. I think due to the pandemic, I think there'll be a lot of leeway, although it's probably ripe for abuse as well. So just be diligent in what you're doing and be reasonable, I think, and you'll be just fine.
And then one of the unexpected but very beneficial changes that came about due to the pandemic was the charitable donation change. And the first thing is a lot of people weren't itemizing deductions after the 2017 tax law change and weren't getting as much benefit from any charitable donations that they made. And to sort of give another benefit this year for 2020, if you and your family donated $300 or more, but are itemizing, you can still claim an above the line $300 charitable deduction on your return. And they went a step further, and for 2020, they have increased that so that married joint filing taxpayers can deduct up to $600 on an above the line. So even if you are not able to itemize deductions, you can still get an extra benefit through this change. So any donations you made, if you hadn't been giving them to your CPA or reporting them in the past, it's worth tracking and noting for both 2020 and 2021.
Okay, I'll take these next couple of slides, and this was a pretty popular topic with a lot of clients and taxpayers wanted to understand what was available to them in terms of the retirement accounts with some of the legislation that came out last year. And as this notes, to aid COVID-19 victims, taxpayers impacted by the pandemic were eligible to make withdrawals up to $100,000 from their 401k. The taxes and income on the withdrawals were spread over 3 years. However, if you did return those amounts, you won't be taxed on them. You were able to avoid the 10% penalty, even if you were under the age of 59 and a half. The Congress has not touched this topic for 2021 yet. For 2020 and 2021, the limit on contributions to IRAs and Roth IRAs are $6,000 plus a catch-up $1,000 contribution for those that are 50 and above. For 2020, there was no age cap for individuals contributing to traditional IRAs. However, you still have to earn wages or self-employment income to be eligible to contribute to these accounts or have a spouse that does. And remember, your deadline for contributions to your IRAs is as of the date you file your taxes. So you still have time to take advantage of this. There are other limitations, and I would consult your tax advisor based on income or participation in other retirement plans. I'm not going to go through these contribution limits, but they are there for everybody to review, and we'll make our slides available to Ashley afterwards, and she can. So if you want these for reference, you'll have them. FSAs, as most people know, FSAs are employer-sponsored plans that allow you to set aside pre-tax dollars to pay for unreimbursed health expenses. The limit on the FSAs is $2,750 for both 20 and 21. So you could technically put in $5,500 each year per couple. The dependent care FSA's limit is $5,000. Under the new rules, workers, you can now carry forward unused funds from 2020 to 2021, and then same for 2021, carry forward to 2022. Or if your company is a fiscal year company for 12 months after the fiscal year. There's also a credit on dependent care expenses. It's 20% of qualified expenses up to $3,000 for one child, or $6,000 for expenses of 2 or more dependents. One of the catches with the FSA is that for middle and upper income taxpayers, a dependent care FSA is often a lot more valuable than the dependent care credit. And again, that's something you'll want to discuss with your tax advisor. And please note that you can't double dip and get a dependent care credit for expenses paid with FSA dollars. There's the legislation that came out last year as well provided some great relief for business owners with respect to net operating losses. We had a large number of clients take advantage of this. And I'm going to let Lindsey talk in detail about these benefits that were available to you last year. And so if you have not taken advantage of it, or so you can note it and visit with your tax advisor as well.
Yeah, so after the major tax law change in 2017, businesses weren't able to deduct losses against past profits, and they were even limited into how much those losses could offset their current profits. And in 2020, as a result of the pandemic, Congress recognized that by removing these limitations, it could get money into the hands of taxpayers more quickly if they fell into these categories. And so for the 2018 through 2020 tax years, business owners have the ability to carry losses back for up to 5 years, and those losses can offset profits and generate refunds of tax that was paid during those past 5 years.
And that was a big change prior to the 2017 Tax Act under President Trump. Taxpayers, non-farming taxpayers could go back 2 years, and farmers could go back 5. And 17 removed carrybacks for non-farmers, and then farmers could go backwards 2. So this was a significant change and relief to permit, 5-year carryback to go back and catch previously paid taxes.
Right. And so what the limit that was removed in place was, if you were a married filing jointly taxpayer, you could deduct up to $500,000 of a business loss in a year to offset your current other sources of income. And that limit was $250,000 for single taxpayers. And they removed this limitation. And that is what allowed much more of losses that may have been limited to flow through and give people the ability to do these carryback claims. And so even if you were a farmer, for instance, and did a small carryback in 18, with the removal of this, you could have had a much bigger loss and take advantage of it. And so if that, is a situation you're in, and haven't already taken advantage of this, it's worth a conversation with your tax advisor. And as Jason mentioned, we've all got a good grasp on the Paycheck Protection Program at this point. But one of the things that was kind of an up and down topic throughout 2020 was, what are the tax consequences going to be of this? And the IRS came out with some rulings that were not taxpayer friendly, and saying that they would be disallowing any expenses that were used to get loan forgiveness. And Congress realized that, that wasn't their intent under the CARES Act. And late in December, they did push through the legislation that corrected this and very clearly made it known deductions that were used for forgiveness are allowed. And so it really truly is a tax-free transaction if you were a PPP recipient. However, not all the states have conformed to that. And so if you are a filer that has received a PPP loan and you file in multiple states, it's something you want to make sure that your tax advisor knows that you had loan forgiveness in 2020, so they can look at the rules for those states.
Okay. Yeah. Yeah. Okay, I'm sorry. Got my slides mixed up. All right. So one of the more hot topics right now, now that everybody's had their PPP loan and it's applied for forgiveness, everybody's starting to look back at whether or not the employee retention tax credit is applicable to their business. And while it's been few and far between from our practice, I believe, that have been able to use it, it is absolutely, especially for 2021, a little easier to attain and pursue. The credit originally, as expanded in December, covered 50% of wages from March 13th, 2020 through the end of the year, and 70% of wages paid in 2021 through June. So businesses can receive $5,000 per employee for 2020 and up to $14,000 per employee for 2021. Businesses for 2020 had to meet the requirement of generally had a quarterly revenue compared to 19 of 50% decline. So if I'm looking at third quarter 2020, I'm comparing that to 19. And if my revenues decrease by 50%, then I qualify. That's one step in qualification threshold to qualify for this credit. The change for 2021, which has gotten a lot of people's attention, is that it only needs to be 20% decline. So it has gotten a lot of attention. My view of this is that, obviously the ones you would think of will qualify. Hospitality, and in some of these food service and in other industries that were particularly hit and continue to be hit by the pandemic. The other eligible qualifications is if you were subject to government restrictions or closures. That's a little more of a nebulous standard, especially in particular the government restrictions. How that's defined and how it would be viewed is a little unknown right now. Closures obviously are a little easier. We work with a lot of companies that were deemed to be essential industries. And so even if they were in states that had closures, they didn't qualify for this credit. If you meet the revenue decline standards, whether that be for 2020 or 2021, you have an employee count that you have to meet. Again, for 2021, it became a little easier. It was businesses with 500 or fewer workers can apply for the credit. The threshold in 2020 was 100 or fewer workers. If you have employees above those levels, the only employees that you will qualify for are those that were stated that were at home due to restrictions or other imposed closures or decisions on that company, and they were at home and you were paying them to stay home. Please note, and I think a lot of people miss this point, but smaller employers can also request an advance payment of the credit to assist with cash flow. One of the other popular topics last year were payroll tax deferrals. During 2020, employers were allowed to defer paying half their Social Security payroll taxes as a way of giving them a little bit of a cushion. And then there was a staggered payback. You did have to pay them back eventually, and you were required to pay them back in 2 installments, half by the end of this year and then half by the end of next year. These rules were put in place through Congress and its legislation, and were understood and used by a lot of taxpayers during 2020. If you recall, there was a separate payroll tax deferral that President Trump authorized by executive action. That is not what I've been talking about the last couple of the first 2 points and bullet points on this slide. But the one that was authorized by executive action, it was for the employee share, and it was very scarcely utilized. I didn't have anybody that used it. I had a few call and ask, but I'm not aware of any in our firm that actually did it. But if you did do it, the deferred taxes from the final 4 months of 2020 must be paid back during 2021. This was for business owners, another supposed perk or maybe a way to provide a little more stimulus to those in the restaurant industries. Congress expanded the tax deduction for business meals. Before the change, business meals were 50% deductible. After this change, they are 100% deductible for 2021 and 2022. Some people called this the 3 martini lunch tax change, encouraging a little more lavish spending by businesses on lunches and dinners, maybe from what we did in the past. It will not apply to meals purchased during 2020. It does apply to delivery, carry-out meals, and those consumed in restaurants. So if you're like us at Frost, we order in meals every night during tax season and on Saturdays. So this is a benefit to us. And if you're doing the same, I have clients who are doing that for employees who were working around the clock trying to keep things going during the pandemic, and I'm sure that's continuing today. So this is something to take advantage of and to take note of.
Good news for the Venture Center.
Yes. A couple other small tax breaks that came out of all the pandemic response. Congress did extend the deduction for energy efficient commercial buildings, the lower excise tax on alcohol, and the work opportunity tax credit. And if you don't use any of these, then you should discuss with your tax advisor, in particular the work opportunity tax credit. It does provide an incentive for hiring people from disadvantaged groups. I'm going to turn this back over to Lindsey. Now that we're in tax season, one of the questions that always comes up is, how do I report my PPP loan forgiveness and any credits that I received? And I think there's been some surprise by a lot of taxpayers, in particular on the credit side, as to how that's impacted their tax returns. And so I'll let Lindsey talk on this topic.
Yeah, so well, the first thing is really easy. If you had a PPP loan in 2020 and it has not been forgiven yet, as of the end of 2020, you just leave that as a balance sheet item, or as the debt that it is, and so it will become a 2021 reporting item. But if you did receive forgiveness in 2020 and you file as a pass-through entity, you would show it as other tax exempt income. And the same thing is true for corporations. They would also show it on the information line for where you would put tax exempt income. And then you show it as being a non-taxable item by putting what's known as a book tax difference item on the Schedule M1 or M3 of the return, depending on what type of filer you are. And that lets the IRS know that you had the loan, that you got the forgiveness, and you are properly reporting it and not paying tax on it. And then it, as we talked about earlier with that presentation, it shows the states who sometimes request copies of the federal that you've either gotten this, and they'll know to look for it for the state treatment as well. And as Jason mentioned, several people did claim employment tax credits, and whether that was the employee retention credit that Jason previously touched on, or the credits under the FFCRA Act that provided paid leave for those affected directly by COVID-19, either diagnosed themselves or family members, and their employers were required to give them the 2 weeks paid leave. Employers were in turn entitled to claim a deduction for that and a credit on their payroll tax forms. But what wasn't really well known at the time is if you claimed those credits, the IRS was wanting you to reduce the amount of payroll expense and wages that you claim as a deduction on your return. So you have another book tax difference in that scenario, but a little more unfavorable. And you got the cash in your pocket for the credit, but you do have to reduce the amount of expenses you can claim for the year.
All right, so we've come out of the pandemic section of this presentation, and we're going to hit on a few quick topics and then open it up for Q&A as our time continues to click by. Cryptocurrency. I was on a call yesterday with a client and his investment advisor, and this investment advisor was telling him he couldn't even buy cryptocurrency if he wanted to. So the client was going to have to go out and do it himself. I think this first bullet point, and I bring that point up is to say, obviously it's a hot topic. Elon Musk has everybody worked up about some very fringe cryptocurrency, and it has spiked in price. And I think maybe even if you're on an app like Robinhood, you can go out and buy cryptocurrency now. So it's readily available. And there's a lot of companies that are out buying cryptocurrency now as a normal part of their investment portfolio. But do note that, as I have to say in this first slide, the IRS is on the warpath, and they know there's abuse there. They want you to report your sales of cryptocurrency. There is a question on the front page of your Form 1040 that you have to address it. So if you have bought it, you need to identify yourself and say, yes, I have some, even if you didn't sell it. And this is pretty common right now with the IRS. They're wanting you to come forward and identify yourself and report certain transactions that are outside the scope of this presentation today. But as obviously, when they ask you to fill out, check a box like this, it's on their radar screen, and so they're bringing it full circle to make sure that there's full compliance. And if you are holding more than $10,000 in cryptocurrency, you need to file a form commonly known as the FBAR to report your holdings. Historically, FBAR is for foreign bank accounts, and those who have foreign bank accounts need to identify those accounts and what's in them to the IRS. Cryptocurrency has now brought itself into that same realm. So if you are investing or trading in cryptocurrency, just take note. And the penalties for not filing an FBAR are pretty stiff, or very stiff, and there's very little leeway. So they do not take it lightly. So I would advise you to be fully compliant. Estate and gift. I'm not going to go into too much detail here, but this was again a very hot topic for our clients at the end of the year following the election. For those of you that don't know, in 2017, President Trump and Congress increased the estate tax, your lifetime exemption, up to $11 million and change, up from $5 million. So this was a big bump for those who qualify for it or have estates that are in excess of that amount. That will go away in 2025. Or the fear was maybe that President Biden and the new Congress would take it away even before then. And I think that's a high priority of this administration, or so it's rumored. And so please, if you fall in that category, and I don't, but if you do, you may want to strongly consider making some gifts as soon as possible. I'm not going to get into child credit or dependent credits. We did talk about this a little bit more earlier with some of the increases due to the pandemic, but if you want to review these slides at a later time, you can. And again, just make sure you're talking about all these issues with your tax advisor as you're working through your 2020 return. I'm going to jump back over and let Lindsey talk about the pass-through deduction for business owners. This again was part of the 2017 tax code, came in, and has been a very popular item for a lot of our clients. Lindsey, you're on mute.
Yep, sorry. Congress did make a change to this for 2020, and individuals that have taxable income up to 163,000 and those that file married filing jointly that have taxable income up to 326,000, they have a unlimited pass-through income deduction, whereas in the past, there have been some limitations regarding your type of industry or based on the amount of employees and qualifying assets that those businesses had. And so that is a benefit for those who maybe, don't have high payroll costs or a lot of assets that in the past caused them to be limited. They're now a little bit more free of those deductions. And as we go into the 2021 tax year, those numbers do go up. They put some inflation already built in. And so the single filers see an increase to 164,900 threshold, and married filers will see an increase up to $329,800. And when you cross over those thresholds, those limitations that were in place do come back, and you do see limitations if you're what's known as a specified service. And that includes, common things like medical practices, accounting firms, law firms, anything that's kind of a trade and you are considered the value. Those often will fall into the specified service category. And for everyone else, your limitation comes into play as a function of the payroll that you have and the tangible fixed assets that you have on your business.
Well, that's all the slides we have. We're going to open it up for questions amongst the group. So Ashley, we're going to turn it back over to you.
Thank you so much, Jason and Lindsey. As he said, we are opening it up for questions. If you do have a question, feel free to post that in the chat box. We can ask that question there, or we've got a small enough group here. We can just go ahead and unmute yourself and ask your question live if you prefer to do that. Let me go through here and see if any have come through. Question about how new some of these updates are. If, for example, if someone's already filed their taxes, or some of these new, do they need to get an amendment?
Possible. I know that I'd read that even with the unemployment benefits that came through in the latest stimulus package, there were people who were going to have to amend their returns. I think when I say in terms of amendments, I would, again, weigh the cost benefit, talk to my tax advisor. If you miss giving information to your tax advisor, or if he or she inadvertently missed something on your return, see what it would cost to amend and what is the tax benefit to you, and then make that decision if you want to amend or not.
Good advice. Another question asks, for homeowners trying to be more sustainable, what deductions are there for things like solar panels, et cetera?
Lindsey, have you dealt with the solar credit as much as I have?
I have not had too many. A lot of people I know hit those credits pretty hard the first time around, and I think they phase out after a certain point if you've claimed
I think it may be this year, next year, the solar credits are phasing out. I do expect this administration to revive those or improve upon them, would be my gut. And I've said that, when we're coming out of the election, and there is, of course, a lot of concern amongst a certain segment of our client base of rising tax rates. The other side of it is, I do think while there likely would be under any administration, because of what we've been through, rising tax rates, I do think that there will be more tax credits on the green side that are going to be made available to individuals and companies.
Any other questions that our attendees would like to ask? Like I said, go ahead and pop it in the chat box, or feel free to unmute yourself. And we'll make sure these slides are available too as well. I know sometimes this topic can be a little overwhelming and make you want to pull out your hair. But,
Yeah, my
that's
head
what
is spinning about all that.
exactly.
Lots of questions.
Mimi, did you have anything to add?
No, I'm just saying that my head is spinning, and I'm trying to consume as much as I can, and I have lots of questions, but don't know what to ask.
Okay, well, says Mimi, put our contact information in the chat box. If there's anybody has any follow-up questions, or can always reach out to Mimi or Ashley to reach us. We'll make our slides available. And yeah, Mimi, even for us, it can be overwhelming when we deal with it every day. So it does take time and consultation with your tax professional to get things right. So be patient and work through it.
I think one of the things that you pointed out, Lindsay, is the estate taxes, because there were a lot of, I mean, I hate to say this, but there have been a lot of deaths because of COVID-19 and the estates passing through. So I thought that was an important point that you were making.
Yeah.
Jason, you had mentioned a reduction on the alcohol excise tax. Is that on the state level or the federal?
Federal.
Okay, so as a liquor retailer in Arkansas, that has really no effect on me?
Right.
Okay. All right. That was the only thing that caught my ear. Thank you.
All right. Good to hear from you, Wayne.
Hey gang, sorry for the late arrival. We are preparing for the big demo day for ICBA, so we had a rehearsal that went over. But Jason, thank you for being here with us again. Hopefully today's been super productive.
Well, Wayne, Mimi, and Ashley, again, thank you for inviting us, and we're always happy to help.
Absolutely, and that contact information's been put in the chat. Feel free to reach out to Frost. Maybe you need some additional support. They're the folks that can help, so be sure to reach out to them. Also, like I said, we'll provide those slides as well. Thanks again so much to Jason and Lindsey for giving up, their past hour to share some insight on this topic. It's very important and pertinent right now. So thanks for being available to do that. And a big thank you to you guys at Frost PLLC, Simmons Bank, Wright Lindsey Jennings, and of course the Little Rock Regional Chamber for supporting all of our events. As Wayne mentioned, we have several events coming up, one of which being the ICBA FinTech Accelerator. Be sure, if you haven't, go ahead and register for that and any other community programs you're interested in. We hope to see you all again soon. Thanks, everybody.
All right. Thank you.
Thank you.
Thanks, Lynn.